Hi everyone, this is short video on mark-to-market valuation of forward contracts. Let me put it here. MTM, mark-to-market. This report you normally get from your broker, but it's really helpful to understand what's inside and how it's calculated. There is a formula, but I don't encourage you to memorize it because it just should be understood on a basic level. How does it work? Suppose you have your forward contract for 1 year for €1 million in exchange for USD. USD is your price currency, and it was done on October 1st, 2025. Then spot rate was at that time 1.90, and your forward 1 year rate was 1.21. Okay, pretty standard situation. And now is June 24, and you're trying to understand what's the value of your position for your €1 million forward contract with a maturity date of October 1st, 2026. What do you normally do? You are trying to understand how much it will cost for you to unwind the contract. So how much an offsetting contract costs for you at that moment of time. You go to your broker, or you just have your trading terminal and you can see them online. I mean the rates for forward contract, and you're pricing the contract. But now it's for 3 months. Yeah, it's end of June, so July, August, September, 3 months, and October 1st, 2025. Spot now is 1.14, and forward, I'm making it up, I don't know for sure, but it's approximately true. It's gonna be 1.145. Here we go. And you are imaginary buying an offsetting contract, and you are ending up with that difference. On an offsetting contract, you have to deliver €1 million at this forward rate. And on your initial contract, you are receiving €1 million. Okay, and the difference between the rate is value mark-to-market goes as the rate for your offsetting contract, and you are comparing it with your initial forward rate. That's the rate difference you should pay to close the contract. Now you're multiplying it by the volume, and here we go. You have $55,000 liability, but you don't need to pay it now. You'll pay it in 3 months. So basically, you can deposit an amount into the bank or money market fund. That's why you have to discount that value by applicable rate. Rate 90 days until maturity, 360, and let's say rate should be in USD. your functional currency. And here you are dividing by this 1 plus yearly rate multiplied by 1/4 of that rate. Here we go. And here you have the value of your 1 million euro contract as of today, with a maturity date of October 1st, 2026. This information is normally sent by your broker or your bank. You don't need to calculate it yourself. Bank estimates it, but it's helpful to understand. It's not helpful, it's important to understand how does it calculate it. Because if you understand, you know how to unwind it, and you know that the underlying process is for the valuation of the contract. And you kind of can understand your approximate position at any point of time just by comparing your spot rates if interest rate differential between your currencies approximately stable. It used to be stable, and it's normally doesn't change that often. There was a period there for 2 years the differential was 2%. Now it's changing. So overall, during these 2 years, by looking at the spots, you kind of can understand where you are in terms of asset liability. Okay, this about mark-to-market, pretty simple, but really important to understand the underlines. See you.